Hello, everybody. It's so great to see you here. We've got an exciting half hour, 45 minutes set up of great content for you. I just want to quickly introduce our company, and then we'll get you right over to Itay. So we are Equi. We are the first digital family office. We are a way that you can invest in a diversified basket of liquid alternatives. Both me and Itay, we're both heavily invested on this platform, so we stand by this product, almost like turning ourselves into a digital family office. We're very excited because we love putting together this content. The most important person of the day is yours truly, Mr. Itay Vinik. Itay is not only a co-founder of Equi, but he's also the CIO. So all the investment decisions are going through him. Itay, do you want to say hi real quick and tell us what we're going to see today?
Yeah, thank you so much for the great intro. I'm going to hop right into it. We are Equi. We make elite investing accessible, and we do so in a fairly easy manner through a tech platform. So I will cover what we have today. Market update today is January 23rd, 2023, and it has been an interesting start of the year. Markets actually have been on a relatively upside slope since the beginning of the year. And I wanted to start today a little bit different, covering the so-called short-term trading view, quote unquote, and some of the things we're looking at when making our own decisions on hedging portfolios and things of that nature. So for those that are interested in our hedging program that helped protect the portfolio in 2022 from this bear market you're looking at and other tactical trading strategies, this is one of the things we're looking at amongst many others. But I wanted to give you a little bit of a taste of the way we look at markets. So what's really interesting here is you can see in January, February of 2022, we went through a regime change. Up until that point, it wasn't very clear when the markets are going to change trend or roll over. But we've seen a few things around that time: correlation pickups, volatility expansion, and other things in January, February. One of the more interesting ones was that for the first time, you can't see going left, but the market's really been on an upswing since March of 2020 until roughly December of 2021. And that was really the first time the market made new lows that exceeded the prior low. So that's kind of your first classic definition of trend change. And then the move up, the first bear market rally actually fails at a lower high. And then we go into that prolonged 2022 bear market. It's been fairly defined as a confined, very orderly, very technical downtrend of lower lows and lower highs. It's really interesting. We're in a fairly major pivot point when it comes to the charts, where the market is attempting to break through the very confined downtrend we've been in for just about a year or even more. You would note here too in yellow is the famous 200-day moving average, which some would use as an indication of where the market trend is. We look at it, but we don't give it too much of a meaning, or we won't basically base our investing decisions based on that.
Cool.
So more interesting than the price chart of the S&P itself is our view of volatility. So don't be intimidated by this chart. This is a chart of the VIX, the volatility index of the S&P 500. And what it's basically pricing is the price of options on the S&P. So when the market is expecting a lot of volatility, that price goes up, as you can see here. When the market's pricing low volatility, you can see that it's going down around here. So in 2021, you can see this red box here. This is the bull market regime. So you see that the VIX really moved between 15 and 25, showing you that volatility is relatively contained. Starting in January of 2022, that really moved up from that 20 area all the way to almost 40. And that really started the bear market. And what you can see is we've been in this much higher volatility environment, really lows around 20, highs around 35. So again, just like the price chart of the S&P, this is telling us that we're in a pivotal point. Is the VIX going to find a floor around this 20 area and move back towards 35? Or is it going to really break through and get into a new regime of lower volatility again?
And Itay, just so everybody knows, what historically does does the VIX tend to revert back to in the long run?
Yeah, so the really long-term mean of the VIX is 20, which is literally where we're trading right now. So very few information from that, but what it's telling you now is that we're again in a pivotal point where markets could start moving back into a bull market volatility regime. We will see that if VIX really cracks below that 1918 area, or it'll move back higher.
In which environment would you be more concerned about?
So definitely the environment in which 20 being below and back towards 35, that would imply that bear market conditions are continuing. I will point out something else. That what you're seeing here in blue is a measurement of the so-called VVIX. VVIX is the VIX of the VIX. So not to be confused, you can think of it as skew. So what that means is how much demand is there for out of the money options versus at the money options. So it's another way of thinking about, are people concerned about extreme price declines, meaning they're buying far out of the money puts, or not? And what's interesting is that the bear market of 2022 has had very little skew, which means that even as the VIX has gone higher and S&P has gone lower, people have not been concerned over extreme price declines. They're not buying puts that are 20% below where the market is trading. That's very different than 2021, where skew was high and people were buying far out of the money puts. So during the bull market, people were worried about extreme price decline. During the bear market, they're actually not. So either most people believe that most price damage has been done already and there's limited downside, or the market is just relatively complacent for being in a bear market.
It's a great insight.
This is another measurement of volatility that we look at, so don't be overly confused by all the lines. I'll explain to you exactly what they mean.
Just make sure to tell us about the colors and which one we need to focus on and why.
Exactly. So we're talking about VIX, we're talking about volatility. So first off, in green is the S&P 500 price chart. Very, very easy. So this is the S&P starting here in 2021, going through the bear market, up and down and up and down. What you're seeing in orange is the actual level of volatility that the market's experiencing. So what's called historical volatility in orange. What you're seeing in white is implied volatility, or what the options market is pricing. What you would note here is that during times where option pricing is dramatically below what the market's actually realizing, options have been too cheap. And during the bear market, prices peaked off and continued lower. We've seen that here in March, April. We've seen that in August. We've seen that in December. And we're seeing that now, where options are really cheap, market's relatively complacent. So that tells you that if this is a bear market, and we're continuing to be in a bear market, it's very possible that we're making another local high and we're going to basically move lower. However, what it doesn't tell you is if we go back into a bull market regime, you see this line here is where the bear market regime really started. This is not as useful as an indicator because markets will continue to grind up. So again, I'm giving you this information of market being in a pivotal point where further upside may indeed mean that the market could have a lot more to go on the upside. But if it rolls over here, it may be very, very risky because options are very cheap and hedges are, the market's way under hedged for what it should be.
And if it's under hedged, that means that some bad news could potentially cause some heavier selling off faster than expected.
That's exactly right. Because if you think about it, if people don't carry put options, they don't carry hedges, the market starts declining because we get any type of bad news. And people will have to buy puts, and that will force a lot of selling into the market. So it's a relatively vulnerable point. This is what all this information is telling you.
And just before the end of the presentation, will you get to a point where you tell us, hey, the next critical dates coming up of announcements that could kind of tell us which regime we're going to go into?
Yeah, so we have the Fed on February 1st, I can tell you right now. And then we have economic data for February.
Okay,
so if you've been following these videos, you'd probably know that the Fed balance sheet, at least in our opinion, has been a key driver of asset prices for years now. We've talked about it going back to 2020 and how the expansion of Fed balance sheet was very beneficial for markets. And then in 2022, when we moved into quantitative tightening, we've been following that as well. So you can see here, S&P 500 index in red versus the total Fed balance sheet here in blue. And we can see how the S&P's prices have been tracking that balance sheet really well, including right now. And currently, quantitative tightening is approximately $95 billion a month of balance sheet reduction, and that's continuing to be the case nonstop. And these are the projections. So that was the 2018. That was cut short as the Fed got back to QE and did not let this continue. But now the projections are for massive reduction in the balance sheet going well into 2024. So the concern is obviously, if this really continues, markets could be in for a prolonged period of decline. And then the question is, of course, why are markets moving up, or have been moving up in January? Any guesses?
You're going to tell us. I'm not going to take away the fun from you being able to spoil it.
So, as has happened over the last, in August and in April as well of last year, it is our belief that the market is trading a dovish Fed pivot already. This is definitely my favorite picture.
Yeah, Jay's got it on. You either stole this from Twitter or Google or something. We're gonna.
I've been trying to find a way.
What?
I've been trying to find a way of putting that picture in every single market call.
Yes, you're doing a successful job at it. All right. Until QT is done, until the balance sheet goes back to zero, we'll see Jay's picture.
Exactly. So inflation has been slowing down in recent reports. There's a lot of speculation going on that the Fed will cut rates in 2023. There's also a belief where a lot of market participants are becoming convinced the Fed will not be able to execute quantitative tightening as well and will shut it off, just like they did in 2018, 2019. How do we know this?
How do we know this?
So when you're looking at the implied Fed funds futures versus what the Fed is telling you through the dot plot, you can see a massive discrepancy wherein the Fed is here in green. So each dot represents a vote of one of the members of the FOMC of where they believe interest rates should be, whether it's in 2023 or in 2024, versus the white line, which is the Fed funds futures, which is pricing dramatically lower rates than what the Fed is actually saying. In the last Fed minutes, the Fed even warned about the market being overly giddy and not believing them, and yet the market is continuing to do that. It also happened in September of last year before Jackson Hole, Wyoming. And Jay Powell had to go on a speech and basically make it very clear for the market that they're not pivoting just yet. The Fed seems to find themselves in the exact same situation again.
Do you feel like the market is just playing a game of chicken against them?
Yes, I do.
Why, from your point of view, if they've been wrong for an entire year straight, why are they continuing to taking this position?
So I do think the pivot is likely to, I mean, the pivot is going to happen eventually. The question is, is the market really trying to fish it out? There has been a lot of liquidity add-on in 2020, 2021. There is still a lot of money that wants to get into the market, wants to chase these assets. And there's been years of conditioning of rising markets and things of that nature. So this is one of the reasons. Another reason is we're really seeing CPI rolling over. And I'll cover that in a second. But what you're seeing here, the divergence between central bank signaling and what markets believe is getting completely unprecedented. So this is another way to look at this. This is both happening in the ECB futures as well as the Fed. But into next year, the market is pricing more than 225 basis points of rate cuts.
That's crazy. That is insane.
And if you plot this chart against what the S&P has been doing, you can really see the S&P has been trading up in response to this. Financial conditions are literally easing. The market is convincing itself that this narrative is correct and we're on the verge of, another bull market. And, the reality is the market could be right? That's what we don't know. Is the market right, or is the Fed going to try to correct the market? And that's really what we have to ascertain at this point.
Well, if the market's right, then bonds are looking like an interesting trade right now.
bonds could be a better trade potentially than stocks, because then you'll have substantial decrease in interest rates. So that's completely true. A way of trading this would be to play the yield curve by going long the 2-year treasury and potentially going short the 10, and then the 2-year will just fall, and that's a very interesting trade. One of the main reasons the market is so convinced is that we're seeing this trend in inflation. Inflation has been rolling over. So inflation peaked at about 9.1% last year, right into the middle part of the year, into the summer, and has fallen from 9.1 to 6.5%, and has been going down report after report after report.
Yeah. So the one comment that I'll have is, okay, great. The market can signal that there's going to be a rate cut, but then you're going to have inflation wave number 2. What the heck is going to happen then?
It's like you've seen a future version of the slide deck, and you're already predicting.
Oh boy, I actually haven't seen the slide deck. So you can just tell me. You can be like, no, just stop. Okay, well, we'll see what happens then. Okay.
So, to this point, it's true. Inflation has come down quickly, and the market's already extrapolating from that it will continue to go down to 2% just like that, and it's over. But when you're really looking at the different components of inflation, I don't know if that's necessarily true. So maybe we have fallen really quickly from 9 to 6.5, but I don't think we're going to be able to fall from 6.5 to 2% as quickly as people believe we will. And the main reason for that is the services component of inflation. So what you're seeing in this breakdown is the different components of inflation CPI. So here was the peak, just over 9%. This part in orange is energy. So energy has come down. Oil prices have slowed down. Natural gas has slowed down. It's a warm winter in Europe, and that brought energy prices quite a bit. That actually even saved them for the time being in gas storage. So that has come down. Food has actually gone up to some, now has been stabilizing over the last few months. We've all seen eggs being up 500%. So that's the, should have bought that instead of Bitcoin.
Yeah, right. Just got long eggs. Yeah.
Long eggs. I wish we could go long egg futures.
I wish we could have put all our eggs in that basket,
Yeah. Put all your eggs in the egg basket.
That's right. Itay, I've like really transitioned hardcore to dad humor now, haven't I? Dad finance humor, please take me away now.
Yeah, 100%. So then we see that commodities, commodity inflation has also come down. But what is very worrisome is this lower blue line that keeps tickling up every single inflationary report, and that is the services inflation. And for those of you that studied economics, you would know that services inflation is incredibly sticky. And that is the cost of your barber, the cost of your repairman, cleaning services, all these services. Once these prices go up, have you ever seen them come down?
The answer is I haven't really, but maybe if there's like a major recession and there's a lot of unemployment, and then finally people are willing to do things a little cheaper, is that the only thing that really turns that around?
That's exactly right. Historically speaking, that's exactly right. So what I'm watching with a lot of concern is this blue line continually increasing. So sure, we've gotten some good news, but these are the things that are very volatile. Energy, commodities, they move up and down all the time. Services is very sticky. It's not volatile. So the concern would be that, the market's trading this wonderful CPI. Inflation's cooling down. Fed's going to pivot. Everything is great and dandy. But what if in a few reports, we don't go back to 2? What if we stay between 5.5 and 6? Well, that means that the Fed's funds rate could really stay 4.5 to 5% for a year or two. I can tell you right now that nothing in the market is pricing that in.
Got it. Super interesting.
Another thing to potentially think about, and this goes to your point back into the 1970s. 1970s inflation, here you can see the CPI in this current market starting in 2014 versus the decade 1967 through 1983. We did see 2 big waves of inflation. And how did that actually happen? Well, inflation initially rolled over in 74 into 75 as the economy entered a pretty deep recession. For those of you that are interested, stock market actually declined roughly 50% during the time where inflation actually rolled over. So this inflation rolled over very quickly. We entered a pretty deep recession. Equities dropped 50%. And what did the Fed do? The Fed cut rates very, very quickly. And some would say too quickly, as it led to inflation wave number 2.
Can I just give like maybe a piece of commentary back though, just challenging you on this? Weren't they cutting one from a higher place, and then 2, you would have had, this would have been the baby boomers then starting to really start families and stuff like that, but we don't necessarily have as large a population then. Do you think that would cause the second wave of inflation to maybe be a little less serious as what we're seeing here?
Yeah, it's a very good comment. So you're right. The age wave and demographics do not support long-term sustained inflation. So structural long-term inflation is probably unlikely. However, I think this inflation was primarily a monetary and fiscal phenomenon because there's just too much money creation in too short of a time, at a time where they ended pandemic restrictions and then everybody grabbed resources simultaneously. I think that the potential second wave of inflation will depend on the response to the potential 23-24 recession. If the response really is easy money very quickly, I mean, you could see a second wave.
All our eggs are in on Jay Powell, baby.
So I'm not necessarily saying that there will be second wave of inflation, but this analog is interesting to watch because this has been following very, very tightly with the 1970s. It will also mean that we hit a stagflationary period, which is even potentially worse than just deflation. Okay, so the pressure on the economy has been increasing, but nothing really has broken yet. And that's one of the other things the market is watching and saying, well, inflation's coming down, all these things are happening, and everything is fine. We're going to have a soft landing, or at least that's what the market wants to believe. So what you see here, you've seen this chart before, it's getting worse. So we know 70% of the US economy is consumption, it's the consumer, it's purchasing, and the US saving rates has collapsed far below now the pandemic. So here's that pandemic boost. That's stimulus check number 1. That's stimulus check number 2. It's all gone. It's all gone with the inflationary spiral. And how did we pay for everything? Well, we put it on our credit card. Credit card debt hit all-time highs. But also credit card interest hit all-time highs too.
Yeah, you can rack this debt, but can it be paid back?
19% is what you're now paying for those balances on average. And that's a problem. That's a big problem. So what we're seeing in the big four, so big four, JP Morgan, Wells, Citi, and B of A, we're seeing loan losses starting to come up. It's interesting that post-pandemic, with this flood of liquidity, this actually went negative as people are paying off debt, but those days are gone, starting to come back up. Look what happened in 08, 09. This is something we really are watching to see. Are we going to start seeing this type of private credit defaults, personal loan defaults? It's going to be a big tail for the rest of the economy. This is definitely picking up, and we're watching it.
Itay, can you just really quickly remind us again, what is a loss provision and how does it kind of show up on a bank's financial statements?
Yeah, I mean, just generally, this is money that they know they're not getting back, and they just write it off.
Okay, perfect.
Yeah, so in fairly simple terms. So then, you think about the consumer and the small time loans. I think this is the biggest chart out there. Corporations themselves had a flood of liquidity coming in 2020 and 2021, and they've issued a ton of bonds. And why wouldn't you? Rates were at 0. We had literally the lowest 10-year yield we've ever had. So a ton of borrowing was taking place. However, there's going to be an enormous amount of maturities this year, and either that money is going to get refinanced on much more expensive debt, or it's not going to be retaken and principal is going to be paid, but that's going to act as a potential suck in liquidity and could lead to very large scale layoffs.
Okay, Itay, so this is a serious graph here. So we got to take a minute. I understand 70% of corporate bonds are going to need to be refinanced. Can you turn that into like a number? Like what notional amount are we talking about here?
Yeah, I don't know the exact amount we've looked at, but it's in the trillions.
Okay, so in a trillion, so that means that hey, the lower interest rate payment now somebody has to come up with the principal to pay it back, correct? And then if they're going to take out a new loan, then they're going to have to hit a much higher interest rate. So then where's the cash coming from for these companies if they're already like bruised and battered?
Yeah, so that's exactly a part of the issue, and I believe the number is close to 2 trillion. I'll double check that, but it's a fairly large number. It could be a huge liquidity suck.
2 trillion. That's just two Federal Reserve or United States government platinum coins. This is easy.
It's pretty easy. Too bad the corporations don't have access to those coins.
That's right. That's right.
Awesome. At the same time, the labor market, though, is still strong. And that's one of the most interesting parts about this well-telegraphed recession, right? This is one of the reasons that markets are thinking that this could be a soft landing indeed, as inflation is coming down. There hasn't been mass layoffs. Consumption is still taking place. So is everything still going to be okay? I mean, it is a possibility that we have to entertain, right? That the economy is strong enough to absorb this. Inflation is going to come down quick enough. The Fed's going to start lowering rates, and that's going to solve all of these problems. So we can see right now that the jobs market is still inverted. I mean by this is that there are still almost 2 times more job openings than there are unemployed people. And that's a fairly rare condition that is an incredibly tight labor market. So we are still seeing positive NFPs, and it's still a very, very strong labor market.
Itay, when the Fed looks at this chart, what ratio do they want to see? Or like
they at least want to see it 1-to-1. They don't want to see this level of tightness in the labor market. And this is what I think one of the issues where the market is trying to say there's going to be this 200 basis point rate cuts. It was, okay, show me the negative NFPs for that. And we haven't seen that yet. In a weird way, if you get very negative jobs number, that could be a bullish catalyst for the market. And when you're getting positive numbers, it's not. So right now we're in this world of bad news, good news, bad news. But if the recession gets really bad, bad news could become bad news. I know it's a little confusing, but markets right now looking at bad news as good news and good news as bad news.
Okay, sounds good.
And at the end of the day, I think it all just comes down to the fact the market just wants a soft landing. The question is it really going to happen? If it is, it's going to be great. We're going to go back into a bull market and, growth. I don't think it's going to be the same level of growth as, let's say, 2021, right? Because that's just massive infusion of liquidity, probably more gradual because the Fed fund rate's not going back to zero. However, if you don't get the soft landing, the downside from here could be substantial because there's very little hedging, and I believe most market participants are not prepared for this. Okay, so in this section, we're going to just move into some quick charts. We can talk about it very quickly, but just other things from what we talked about that could be of interest. Okay. The market's turned into a giant casino. Over 50% of S&P options literally expire the day of. So 6.5 hours options are traded. Everybody's just speculating on the direction of a few hours, and it just keeps increasing.
But why did this happen? Is this the professional investors, or is this retail people that are doing this?
It's unclear. There are rumors of both, but it's very hard to say how this actually started, but it's having a lot of impact on intraday volatility and option pricing. So we've seen option pricing being very low on a relative basis. This might have something to do with that. Global earning estimates are collapsing. So there's a lot of expectations for earnings to fall, and it doesn't seem to be reverting anytime soon. Equities currently, based on some Bloomberg estimates, are only pricing in about 60% probability of recession versus other assets. So if you look at the 3x10 yield curve, we're almost at 100% probability of recession. So of course, equities would be lower if the probability of recession increases, potentially higher if it decreases. High yield credit, incredibly low probability of recession. So again, signs of concern as the market potentially is ignoring some things. However, it is important to note that market could be right, and we may narrowly avoid a hard landing. That's still TBD. Why is it important to see what the earnings revisions are? Because in a bear market, equities would usually bottom out 6 to 9 months before earnings reach their lowest period. So when earnings are literally the worst of the worst of the worst, equities have already bottomed out. So just something to keep in mind as we're seeing these revisions lower and lower and lower. If these revisions start going higher, you're most likely to post the bottom of the market based on history.
And the revisions that you're looking for are this green line.
Yeah, the EPS revisions. So far right now, they're still falling. And it is interesting because, the price is not going to trough right when the revisions do. It will always be earlier. The market will sniff it out.
Okay.
Goldman had a catastrophic earnings miss this past one. So, I do look at them as some kind of a barometer, a very strong Wall Street firm. Very, very negative quarter, so something to be watching. I like this chart a lot. In 2017, have you invested in ARK versus investing in the most boring farm equipment, industrial REITs, office cleaning supplies, uniforms? Guess where you'd have been better off?
You'd have been in ARK because you could have told all your friends that you were in it.
Right. You should have bought ARK in 2017 and sold it right there and then got into this, right? That's
never how it works.
I read this crazy statistic today that 98% of everybody that ever bought ARK is down.
Unbelievable. Madness.
About the housing market. Stunning.
This is
KB Homes,
what I'm interested in.
KB Homes said the cancellation rate for new home buyers on contracts. So people got into contracts, put down payments a year ago. 68% of them are canceling the contract. They literally can't close.
So what does this mean for the home builders if they can't do it? Do these just sit stalled?
So it's possible that a lot of this inventory is going to be hitting the markets in the next few months unsold, which would massively add to housing supply across the country. So putting potential pressure on the housing market as these numbers continue to increase.
Got it. So if that's happening, and then if people get laid off and have to sell, and then people could, then real estate, to me, it seems like real estate could be in an interesting position potentially. Do you feel that way?
If the labor market really deteriorates as expected, then then we really have the conditions for that to happen. What you're seeing here is the total amount of sales, pending volume, etc. So, this is basically now at 09 levels. This has completely fallen off a cliff. So typically leads price hasn't happened yet. I think what we need is the labor market to deteriorate, but the fact that home builders are getting cancellations and they're not selling definitely adds to supply that could add price pressure lower. So completely possible.
Yeah.
And again, back to that US housing chart, the annual cost of a mortgage based on the current price is as high as it's been in decades. So not even 08, you have to go back to late 1970s, the period of that crazy inflation. 45% at the average wage to pay for the mortgage of the average house
that's if you took a mortgage at the current market interest rate.
That is correct. So the market's telling you two things: prices have to come down, or rates have to come down. One of the two is going to happen, or even a combination of the two. Because I don't see wages going up to that level that quickly. So you can really see the difference in affordability from 2019 is just stunning. You go from 20% to 45% in such a short period of time.
Yeah, I saw a great tweet, which is like, have you ever seen, golden handcuffs? Ask somebody with a sub 3% mortgage.
I'm one of those people.
I'm one of those people too. We're gonna live and die in South Austin.
So what you see here, we're seeing a little bit of a kink in the treasury curve. We're seeing a lot of political uncertainty regarding the debt ceiling. I think because it took so long for the Speaker of the House to get elected and it was so difficult, this is a potential big problem, as it has to be a bipartisan compromise to increase the debt ceiling. And what you're seeing in this chart is the credit default swap, or the default risk of the United States of America into this year. The price of insuring against the default of the United States has exploded, actually gotten as high as what we saw in the 2011 debt ceiling problem. So in 2011, the United States debt was downgraded. I don't know if you remember that, caused a massive problem in financial markets until things got stabilized. The market's now saying, I don't know what's going to happen in the summer. I don't know if the debt ceiling is going to get extended. They may not be able to compromise. And if so, maybe these T-bills aren't safe as you think.
Dumb question. Who's placing these insurance bets from your point of view?
Well, it has to be institutions, because retail doesn't have access to the CDS market. So, but if you really think about it, the cost of insurance against the United States debt is 70 basis points, right? The 1-year treasury is 4%. So it makes sense to get into 4%, pay 70 bips, and even if there's a default, and the super unlikely chance that it's a default, you actually get paid massively against it. So I can understand that trade.
Got it.
And that's it for today. I hope you enjoyed it. We are doing the best to bring you some of the world's best content in a way you haven't thought about before. And looking forward to seeing you next time.